Sean McCloskey, I want to ask you to elaborate on a topic you and I have discussed before, and it has to do with what a mortgage really says, and I guess the reason why that even matters to a real estate investor. It's something pretty eye-opening to me when we first had the conversation, and when you're developing your business, I think if you have in mind some of the things we've talked about, it can really have frankly, a huge impact in how you plan your business and how mortgages play into that. So could you share a little with me about that?
Well, absolutely. Well, the whole purpose of our businesses are to set us free, and it's really hard to be free when you're spending so much time serving a lender. So I spoke at an event recently, and I asked the entire audience, how many of you have debt right now? And what was interesting is 100% of the room raised their hand. There was about 200 people in the room, and every single person in the room raised their hand. My next question was, how much easier would life be if you woke up tomorrow and all the debt was gone? And I said, how many of you feel like life would be easier? And every single hand went up. So what's interesting is most of us have either applied for a mortgage or some type of credit in the past 12 months. And I'd like to define what it is that you really signed up for. Because the next question I asked is, how many of you have signed a mortgage in the past year or two? And again, almost every hand went up in the room. These were all investors. And I said, how many of you read what you signed and understood it? Which is a very different question than how many of you read it. And only one or two hands went up. So everybody signed on the dotted line for a mortgage. Very few people fully understood what they signed. And I said, let me share with you what you signed. I'm going to put this in layman's terms real quick, but here's basically what it is that you signed. The lender gives you a document when you get a loan, and it basically, in a nutshell, says, I am giving you a loan to purchase this house. Now, I'm giving you the loan because you can't afford to buy the house on your own. If you could afford to buy it, you wouldn't need me, the bank. But since you can't afford it, you're coming to me, and I will, in fact, pay for the house and allow you to live in the house, provided that you serve me faithfully with a portion of your time over the course of the next 30 years. And I'd like for you to serve me with somewhere in the neighborhood of 1/3 of your waking working hours for the next 30 years. That's basically what a mortgage company uses to determine whether or not you can qualify for a loan. If you make $10,000 a month, for example, you're able to qualify for a loan that has a monthly payment of roughly 1/3 of that, which means you would qualify for a $3,300 monthly payment. So the lender says, as long as you provide to faithfully serve me with 1/3 of your time that you spend during work for the next 30 years, then I'll allow you to live in the house. If at any given point in time over the next 30 years, however, you fail to faithfully serve me with a portion of your time, or let's say the value of your time changes. In other words, you had a job that was making, and I use 10 grand to use round numbers. Let's say you had a job that was making $10,000 a month, therefore your mortgage payment was $3,300 a month that you're approved for. But let's say that you lose your job and you can only get another job that pays you, let's say, $6,000 a month. The loan balance and the loan monthly payment does not go down even though the value of your time changed. So the lender is basically saying, if you'll serve us with this portion of your time for the next 30 years, then we'll let you live in the house. If, on the other hand, at any given point in time over the course of the next 30 years, you fail to serve me, the lender, I'm going to take the house back. And if there's equity in the house, I get to keep it as the lender. And if there's not equity in the house, in other words, if you owe more on the house than it's worth, then I, the lender, have the right to sue you for what's called a deficiency, and you'll have to pay me back the difference between what you borrowed and what got paid back. So most people don't realize this is what they signed. They signed away a portion of their time. Most people look at it as, well, I can afford the monthly payment. But what you just promised away was 1/3 of your life for the next 30 years minimum. And if at any time you fail to serve, you lose.
Well, has a little different flavor to it when you put it that way. One of the things that's interesting is we have come to believe that, first of all, let me point out that our language tends to be off when we talk about mortgages. And most people you hear talk about getting a mortgage, and it even affects it a little bit when you really put it in the right box by stating it clearly. You're giving a mortgage on
Correct.
Your property. You are surrendering something. Also, though, I think that we've come to accept as kind of part of the quote-unquote American dream that part of that is to go out and buy the best house that we can afford with the monthly payment. and get a mortgage and, just kind of work hard and pay it off in 30 years. And then, at some point at or near retirement, then, provided we haven't refinanced too many times or upgraded too many times, we'll be able to finally have a house free and clear. And when it comes to investing, you see the mortgage as this quote unquote good debt tool that you can leverage over and over and over again. So how should, in your view, seeing a mortgage for what it is and hearing what it really says in its essence, how should that impact, do you think, the decisions that we make in our lives with respect to mortgages and how we see, kind of the normal quote unquote way to be living the American dream and or investing in real estate?
Well, first, let me address the good debt, bad debt thing. We've all heard, Robert Kiyosaki made good debt, bad debt very popular with his book, Rich Dad, Poor Dad. And while I do agree with a lot of what he said, I learned a lot from Kiyosaki. That's the one thing I don't necessarily agree with. The reason I don't is because good debt is only good debt when the asset is performing. And here's what I mean. Good debt is termed as something where you go out and you get debt to acquire something like a rental property, for example, that will bring you in money every month. And they say, well, as long as you're making positive cash flow on your debt, then everything's fine. The problem with that approach is when the property goes vacant or when a tenant stops paying you, you still have to pay the bank, which means now that asset went from a good debt asset to now it's costing you money every month. So in the best case scenario, that whole philosophy of investing works fantastically. But the problem is, after having done now probably 300 or more short sales with investors of all different types, with homeowners of all different types, I've done so many short sales now that I've seen firsthand, no one ever meant to get behind their payment. No one ever meant for the tenant not to pay them for 6 months or 8 months or file bankruptcy and not pay. No one ever meant for a tenant to leave the house trashed when they left. And all of those good debt assets that I helped bail out of foreclosure, none of them were ever intended to be where they were. They turned into bad debt very quickly when the scenario changed and ended up not being a perfect scenario. So good debt, bad debt, yeah, but why don't we just say, rather than good debt, bad debt, why don't we just say, what if we could do it with no debt? That's what gets me excited these days. And there are ways to invest without any debt at all and still accomplish the exact same thing that you were trying to accomplish by going out and getting a mortgage.
Okay. So I guess in answer to the question, what then shall we do now that we kind of hear the language of a mortgage as tantamount to slavery or at best indenture servitude of a sort, what would you say is the answer? I mean, what then shall we do? Shall we look at how to invest debt-free instead? Shall we be more careful with our mortgages? What's your best advice to the people who hear this and are stirred by it and want to respond in some way?
Well, absolutely, and I'll just share one thing, too, before I even answer that. How much differently do you think people would feel? When you get that mortgage and you get the stamp on the top, you picture the big stamp coming down that says approved. How different would people feel if that stamp said enslaved rather than approved? I think it would make them feel quite different. So what to do about it? Well, first of all, you need to educate yourself on how to invest without debt. When I made the decision to stop borrowing and never borrow a dollar again in January of 2009, I didn't know how I could accomplish the same goals without acquiring debt because, quite honestly, people don't teach that. So I don't have time to go into every debt-free investing strategy right now on this call, but the fact is you can accomplish much of what you're trying to accomplish by taking on financial partners that are willing to put up the money and get a return on their investment. I don't mean you're borrowing money from them. I mean you're doing joint venture deals on a deal-by-deal basis where you have a funding partner and you have somebody who does everything else, like acquiring the deals, like if it's a rental property, for example, managing the rental property, things like that. There are plenty of ways to invest without debt. The problem is people don't ever take the time to think it through because debt has been so easy. It's been historically so easy to acquire, and that seems to be the American way. But in my opinion, the American way ultimately is freedom, and the more debt you have, the less free most people feel, especially when things don't go perfectly.
Well, investing debt-free feels like this thing that is almost impossible or just so hard to reach and so far off in the future and requires so much wealth before you can even consider it. But I know from my conversations with you that that's just not the case. That's a misnomer. It's a mistake that many people make. They just haven't discovered how it can be done. And you just touched on a couple of ways there, and I know we're going to talk more about that in the near future. But I guess I would say one of the biggest decisions that I think people could make would be to be a whole heck of a lot more careful about signing willy-nilly on mortgages and really understand what you're signing up for and start challenging yourself to learn to think outside the box, which we'll talk more about in the near future, about how you can go about investing and doing it without debt. One of the things I've heard you and Steve say that has always resonated with me is you never hear of a debt-free investor going belly up.
Right. Yep. You never hear of a debt-free investor getting a divorce because they've got financial problems.
Right. Right. And every time you do hear of an investor, conversely, who ends up losing his shirt, in 100% of the cases, unless there's fraud involved or something like that, it's because something got squirrely financially and they couldn't keep up with the obligations of their financing. So
that's right. And the story is the same every time. I mean, having done a few hundred short sales now and attempted a lot more than I've actually successfully closed, the story is the same every time. It's always, Sean, I was just fine until, and fill in the blank. And the blank could be, I was just fine until I lost my job, or I was just fine until the tenants trashed the house, or I was just fine until my wife got sick and we went from 2 incomes to 1, or Sean, I was just fine until the market changed and my investment wasn't what it once was. The reasons can be, it doesn't matter. The story is always the same. The reason might change a little bit, but it's always, Sean, I was just fine until, fill in the blank.